at the online edition of the Growth Strategy Tour, which is part of the Master in Innovation Entrepreneurship at the Antwerp Management School. So this year's topic is accelerating business in uncertain times, the New York perspective versus the Tel Aviv perspective. This morning we were in Tel Aviv, at least in a virtual way, and we had interesting talks of the managing director of Techstars, and a few experts in corporate innovation from Philips and EY. Now we flew back to New York, where we're very happy to have two clever entrepreneurial guys with us. Today we have Joris Noreilli and Jean van Damme. It's a bit weird to say, but in these times and in an online context, but Joris, the floor is yours.
Thanks, Robin. So I hope you can all hear me. Let's keep Q&A at the end of the session. I'm going to take a quarter of an hour, 20 minutes to go through my slide deck, and then let's take your remarks later on. So welcome, everyone. Just let me start by introducing myself. My name is Joris Noreilli. I'm a Belgian national, which has had a relatively classic trajectory in finance roles in different industries, in bigger corporates. So I worked as an auditor and as a controller and finance director. The moment that I got more or less fed up with that was 5 years ago, where I started to work for startups and scale-ups here in Belgium. Long story short, we incorporated a larger association called CFO Rent. We are working with a couple of people right now, around 10. And given the nature of a lot of these startups and scale-ups, given their growth rate and given their international perspective, a lot of them actually have quite some ambition abroad and move to the US. You will have talked to people from Belgium by now, I suppose, and you know that they provide a good landing spot both in New York and in San Francisco. Work-wise, I do spend a lot of time, or I'm supposed to spend a lot of time in New York. I'm as locked down as you are. Typically, I would spend around 20 to 30% of my time in New York. And what you see at the right-hand side is that little red dot where our New York office is located, very nicely overviewing Manhattan. I invite each and every one of you, by the time we are allowed to take the plane again, to pay us a visit at that moment. Let me check. Okay, very well. So let's dive right into it. You might have noticed there's a bit of economic turmoil going on. Now, when we check the resources that are looking beyond the day-to-day news, we do see that, yes, times are bad, and yes, there is a slowdown, there is a contraction of GDP of double digits, but that doesn't mean that in a couple of quarters things will not pick up. So depending on which scenario you wish to believe, and I think we are in some kind of virus containment scenario, both in US and in Europe. The expectation is that GDP growth will pick up at the end of this year, early next year. That means that, and you see the different colors there, that means that both for US and for the Eurozone, we will be in much better shape by the end of this year, which is not too far out and incomparable to the economic downturn that we had in 2008. Of course, a lot of this depends on our own behavior, on the behavior of the consumer, and on government actions. The conventional wisdom among economists is that after a long period of economic boom, which we enjoyed right now, a relative high amount of cash is sitting on bank accounts of both individuals and corporates alike. Those were war chests that were provided or that were accrued to go on a hunt for taking over companies or doing mergers or fueling that innovation that companies wanted to do. And 2 or 3 quarters of a contraction in GDP is not really going to change that immediately. Next slide is from a study, a white paper from McKinsey earlier this, I should say last month in April, mid-April, we got an update of what they see. I hope you can read it. If you see yourself as a startup, as a scale-up, or as an intrapreneur, so as a branch in a larger corporate which is doing innovative things, I think we resort in that big bucket there called high tech. So obviously on the left-hand side, you don't want to be an airline, you don't want to be in oil and gas, you don't want to be a bank. At the right-hand side, if you're lucky enough to be in pharmaceuticals, that's good news. But not so far away from that, you see that high tech, although it's quite a wide category, so it's quite a big asset class in any economy, the impact is relatively subdued, and that's also the belief of people that we talk to. Also on a macroeconomic scale, what depends much more than the overall GDP evolution is how the specific sector is going to recover. And here we're coming into how investors look at their portfolio companies and at new initiatives. This is also how large companies are going to look at innovation initiatives and ventures that they want to go into in the next few years. It's all very sector dependent. So the overall economy can be slow. Things will pick up always slower than you would want. But again, if you are in an innovative sector, basically the depth of the disruption might not be as deep as you would, as newspapers would make you believe. The length of the disruption and also the speed at which an economy or at which a sector will recover will differ from sector to sector and also from geography to geography. So what we know is that US, especially given its labor market, is an extremely flexible economy. So people, instead of being put on temporary unemployment, what we see in Belgium, people are basically fired or furloughed, which means put on an unpaid leave for an indefinite amount of time. It's brutal, but that also means that it would allow companies to stay in better shape and will reduce their burn until times get better. So crises in US are typically deeper, but the recovery is much steeper than what you see in the Eurozone. Also, when we talk to a number of these private equity investors, we see that they confirm that there are a few trends in the overall behavior of people, of consumer behavior. Let's talk about touchless transactions, online ordering, online video conferencing. All those kind of things have been around for quite some time. Crises, the only thing that they do is basically exacerbate and accelerate those kind of trends. So where certain forecasts were that adoption curves are going to stretch out in 10 years, basically what we will end up with is probably to see that effect in 10 months by now. In the next slide, what you see there is a matrix that most financial managers in larger corporates, most CFOs and also their investors will have in mind. I'm not going to go through it in full detail, but suffice to say, there are a few short-term and a few longer-term measures that companies will take to preserve their cash. Cash is king again, at least in the sense that people want to sit on a large amount of cash, basically to sit out this thing until the end of the year if needed. This assumes a bunch of short-term measures with which I'm not going to bore you. So collecting overdues, all that is quite evident. On the longer term, what you will see is that companies will keep their purse closed for a number of initiatives, and more or that on that cutoff that certain industries will apply to assessing the payback of certain new ventures. We'll talk about that in a few moments. When we talk about real initiatives, when we watch what the real big private equity parties are saying right now, where their mind is what you can see here. Insight Partners is a private equity located in New York at Bryant Park. They have had 6 or 7 funds, each around $6 billion. So these are big fish, where the focus, as per today, is on defending their existing portfolio, supporting their existing portfolio, with again helping them withstand the weather. They keep their eyes open on how the lay of the land is, and they will keep an open mind somewhere in the next few months for new initiatives to come in. We know from experience that Insight officially is saying they're defending their portfolio. They are still going to be on the lookout for opportunities in investments. These type of funds, what they typically do is wait a few months until where they know that lesser funded competitors or adjacent services will run out of cash or will suffer from reduced revenue, and go on some kind of shopping spree. And that is exactly why some of these companies are preserving cash, because you do know that it's going to be sales in somewhere around summer or in the early autumn. Similar thing, I believe, with Index Ventures, officially the largest fund in the world, or the largest private fund in the world, at least, where they say, the 2020 plan is no longer the plan. So all of that, and I can attest from my own experience, all of that budget and budgeting and all of that long-term planning has been thrown out of the window. Lots of scenario building, lots of what if questions coming from investors and boards towards these initiatives, and they will pay attention again to companies where the founders are aware of the gravity of the situation, who want to take things seriously, but who do not put a full stop on the entire deal flow that they are so much depending on. I've been talking largely now on the large private equity and the VCs. Why? It's interesting to talk to these parties. It's a growing and quite an innovative, but quite a growing asset class you see in the financial markets. We're talking about funds of more than 500 million euros or dollars assets under management. They have typically had a extremely good track record in the past 10 years. So since the financial crisis of 2008, 2009, they have been literally building up large portfolios. We've seen a few very big IPOs. These are the guys who typically trigger those IPOs because they want to cash out on those investments and pump it into a next investment. So they have been able to literally vacuum clean the money market. They absorbed all of the venture capital, and they have a substantial amount of money on the bank account. So these kind of companies, the last thing that they will want to do is keep that on a bank account for half a year or for a year. That almost never happens. They will want to put that money at work, because obviously keeping it does not really give a significant return. What you will see is that things like IPOs or large M&A events will be more or less paused until autumn, and we already saw from March onwards that multiple valuations, or let's say evaluations of typical attractive investment targets have been going down by up to 30%. mid-sized funds, a bit together with the with corporate ventures. What we see is that, again, if they do have a proven track record, they will continue to invest because they will have that confidence. But they will want to prioritize funds to defend their existing portfolio. Same thing for corporate ventures. They will want to skip new adventures for now. They will want to double down on the stuff that they have been pushing forward in the last few years. I would say lastly, when you would talk to a US investor, we've been doing that in the past few months and weeks quite a bit. Not much has changed for these guys other than the cutoff. So the requirements, the confidence and the security that an investor will want to have the moment that they will step into a new venture. What does that mean? Sector is important, team is important, and the resilience of the team within that sector. So this is an ideal moment in time for a VC to check how a team under pressure is holding up. All that talk about a good product market fit, this is a time where this becomes really important and where some doubtful or more far out initiatives will not get funded, will have to prove a bit more where they are and how mature they are. But again, if you do have an idea or if you do have a good initiative, there's no reason why this would not go through or why this would not be eligible. They will want to check on the revenue potential relatively short term. And again, a lower valuation if their opportunists will be in effect. So more so in US than in EU, you will feel that larger rounds will be milestones in a few payouts. Overall valuation is dropping. More of the payout is put into earnouts, those kind of things. So they will want to shift the risk more towards the entrepreneur and take less of it on themselves. And that is it for the moment. So I'm going to shut up now and give the stage to Jean.
Okay, thank you, Joris, for this interesting talk on fundraising, also during Corona times. So now we have Jean, an entrepreneur in food tech. Jean, if I'm not mistaken, you're right in the middle of fundraising. Yes. So you can also share some interesting insights on that.
Thank you. Hi, everyone. My name is Jean. I'm the CEO and co-founder of Esther. And before I jump into the session itself, I wanted to introduce myself. First, I'm Belgian. I'm a bioengineer in food technology. Did some coursework in college on beer and wine and flavor analysis. After that, went to work for Möbius in Belgium, a small consultancy firm. Stayed there for 8 years. And then went to work for one of my longtime clients at that point, which was Colruyt Group in Belgium as well, running their R&D and innovation department for 2 years. And so I moved to New York after that for personal reasons. My wife is American. And when I got here, I decided to start Esther, kind of as an opportunity. Being in New York, having to figure out a new life, it was kind of the perfect time. In my session today, I want to touch on a couple of things. And from my background, I set up for Colruyt Group, I set up the corporate garage that they have, or the corporate venturing vehicle that they're using today. So I can share my perspective on the corporate innovation or corporate venturing side. And then, of course, now being on the startup side, being an entrepreneur myself, and fundraising, as Robin said, in New York City. what I wanted to do is start first with basically going through our pitch, telling you a little bit more about how we tell our story to investors today in 3, 4, or 5 minutes. And then after that, I have a couple of thoughts that I wanted to share on the difference between being an intrapreneur and an entrepreneur, and how that translates into fundraising in New York, especially. That's the goal. So talking about Esther, basically where it starts is whenever you drink a beer. And this is a beer that I had right before the lockdown here in New York, together with my wife. It's a local brew with a beautiful color, nice can. And when I tasted it, I loved it. My wife, she loved the can, but hated the beer. And that's basically what the reason we started Esther, is that flavor is very individual. It is dependent on not only what happens on your tongue, but also the context you're in and everything that has to do with that. And we wanted to understand that and use that intelligence, use that flavor intelligence to create better products. If you look at the food industry today, it's a broken process. So we have you go from a raw ingredient in the vineyard or in the maltery, and then you have a producer, you have a distributor, you have a retailer, and then you have a consumer. And in that entire process, all the choices that are being made are made based on money, are made based on margins, are made based on personal relationship, and they're not necessarily driven by flavor. And that's why we started Esther, is because we wanted to put science and artificial intelligence in front and center into that entire process. Basically giving all the players in this ecosystem a better way to make choices, and a way to make choices based on flavor intelligence and not necessarily only economical gain. It started as the story started when I was talking to an old college contact of mine, Kevin, who you see in the photo, who's a professor at the KU Leuven. And we decided to look at customer flavor in a very holistic way. And we decided to look at it in a multidisciplinary way, bringing together the chemical science of it and the sensory science, but also adding to that basically consumers' personal flavor experiences. And again, another layer, we added some contextual information. So when you drink a beer, anything that happens around you is very important. We turn that into 2 products. And the first product is a recommendation engine. It's something that we sell to retailers, to supermarkets, grocery chains, but also smaller liquor stores, both in the US and in Europe, where we basically offer a way to recommend, to help a consumer find its way in their assortment, turning Esther into a personal flavor mentor for the customers of your store. A second aspect of it is that we have an insights portal that we use for retailers and producers, basically offering the same intelligence and the same set of data and insights for these retailers and producers to make better decisions. For a retailer, this translates into better assortments and more intelligent and aligned assortments. For producers, it helps them tremendously in their new product development. So now they need 2 years and they need millions of dollars to bring a new product to the market. We can speed up that process and make it a lot more informed and a lot more efficient. We're still relatively early stage, and I'll talk a little bit about that later. We're focused on creating actionable value. And so we have a project with Colruyt that we are setting up right now that was supposed to start in March, that we're now planning to start in September, where we build our technology into their touchpoint, so both in-store and online, to really help a consumer find its way in their assortments, in their wine assortments in that case. At the same time, we work with producers to give them affordable and very detailed product analyses that helps them make their beer even better. The market opportunity is pretty big, and I always take as an example that there's 200 million beer and wine drinkers in the US and Europe, and then at the same time there's 13 million products in the Vivino database. So there is an enormous amount of products, and there is no way for a consumer to make sense of that and to find its way in that whole assortment. And that's probably the reason why CPGs, consumer packaged goods companies, and grocery retailers are spending up to $10 billion a year on market research. That's why Walmart invests in all the data that they want to gather. And it's why I understand that you had a session yesterday with Amobi. That's why companies like Amobi are so valuable for these retailers as well. We built a team, and important in our team is that based on my background in retail and food science, we needed to add a technical layer. So we have 2 people here in the center that add that technical expertise. And then we have a marketing lead that is very, very well versed in everything that is digital marketing. Important to mention here is also that since March, we're basically the week after the lockdown, we got accepted into an accelerator program called FoodX here that added some investment to our company as well. And that accelerator program is really helping us to create our network in the US. And at this point, as Robin mentioned, we're raising what we still call a pre-seed round, and I can talk a little bit more about the names and why we call it pre-seed. We're targeting $2 million as a raise, basically helping us to replicate our model, build a customer pipeline, build our team, and create a product that is mature, like turn our product into a mature phase, I would say. So that's kind of the pitch that we, and it's off the cuff, but that's the pitch that we use for investors. What I wanted to talk about at first is how that pitch is different from how I would have done it if I was still an entrepreneur. If I would, for example, pitch it to my managers or the people at Colruyt that would decide if they wanted to invest in this kind of project. It's a little bit in line with what Joris mentioned before about what investors look at. What I now understand after doing about 100 pitches in the past year is that investors look at 4 things. They look at the idea itself, whether that makes sense in general, but then they look at how big is the market opportunity, how experienced is the team, and how much traction do you have. And what I think, if you translate that into a corporate context, is that the idea is just as important, but you're gonna probably want to, link that idea to what the company's strategic goals are. So that's one thing that is important. Instead of a market opportunity, you're going to translate like how much money could this make for us as a corporate? How much value can this create for us as a corporate? In terms of team, I would say that if you go to investors, you need to have that team. If you go to a company, you can say, I need this team or I need these skills. And then the big difference to me is that an investor is not going to invest in you unless you have some kind of traction. And I'm happy to answer all the nuances in that. But the key in a corporate is that you have some kind of touch or some kind of information from whether your client would use this. And that can be market research. It can be a very short, quick experiment that you've done. But that always helps. I would say that it needs to be less far advanced than what you would expect in when you're investing, when you're raising with VCs, for example. Then specifically on fundraising in New York, it's I mean, the key is still the same. It's always been the same, and that's the fundamental dynamic of a raise. And basically, as an entrepreneur, I need the money first. I'll show the results later, and I need the money as quickly as possible. That's kind of my point of view or my perspective. On the side of the investor, what they like is they want to wait as long as possible. So if they can, wait another year and then invest, they're going to do it because it basically de-risks their investments. And then they're always going to say, I want to see results. I want to see more traction. And that word traction is something I continuously think about, is like what does traction mean? Like that totally depends on what kind of company you are and what kind of investor you talk to, but you always need some kind of traction before you're going to get your check. A second big thing, and I found that when I was still looking for investors in Belgium as well, that you get a no more easily in Belgium. And just to be clear, a no is normal. It makes sense. Sometimes you're just not a good fit, or you're too early, or whatever reason it is. But in Belgium, you get a no. In the US, you basically never get a no. They're always saying like, yeah, this is interesting. Let's keep talking, or well, let us know if you have this client. And it's basically up to you as an entrepreneur to decide, yeah, okay, this is not going to work out, or this is worth continuing the effort to. And then a third thing is that fundraising is just a lot of work. I split it up in 3 phases, like planning, pitching, and negotiating. The planning phase is, I think, the most important one. You have to decide what the size of your round is. I would say in general, US rounds are bigger than Belgian rounds. What you see in the current context is that investors are kind of looking for lower valuations, as Joris mentioned. So you need to be able to show that your round makes sense, and that the percentage that you dilute, that you give away, is not too high. As a general rule, I would say that in every round you should be prepared to give away about 20 to 30% of your company. Either like a little bit more towards 20 is better, of course. In terms of size, they're going to offer lower valuations. On the other hand, you as an entrepreneur in this context, you want as much cash on the bank as possible. So you want to do a round that is sizable enough. So there is a little bit of a tension there as well today. Very important, secondly, is what kind of investor you want. I always say, don't throw rocket fuel into a lawnmower. What it means is that you have to be ready for the kind of capital that you attract. For example, that's part of the reason why I call our round a pre-seed round, is because I want smart capital. We are not ready in no way for the funds that Joris mentioned in his presentation. Like, we just couldn't do it. And so that's important to know as well. If there is anything off limit, of a certain type of investor, a certain funds that have people that you really don't want to work with, or with a bad reputation, that's also something to think about in the planning phase. And then make a list that is big enough. That's my biggest lesson. Like, you can't go off a list of 10 investors, because for every maybe you get 9 no's. So it's a numbers game, just like in sales, by the way. In terms of pitching, a couple of things. So your pitch changes over time, and I sometimes take my pitch from 2 years ago, and it changes over time, I can tell you that. But at the same time, don't overhaul it after every pitch that you do. And that's a risk that a lot of entrepreneurs say, like, they get feedback and then they say, like, yeah, we're going to do it differently. I think it's important to believe in your own story, and you can change the way you tell your story, but the fundamental dynamic should be something you think about really well. Think about the tale of 100 pitches. Like, again, you need 100 pitches to get an investment. That's kind of the general practice. Get warm introductions. And I would always say that networking, certainly in the US, is incredibly important, because you wouldn't have any chance if you just cold email investors. You need to get a network of founders that can connect you to their investors, because that's basically the way to do it. And then it's a sales story, both in Belgium and the US. You want to you want to get them to yes, and that's totally the same dynamic as a sales story. The only thing is that you're selling your company instead, or part of your company, instead of selling your service or your product. And then negotiating, and this is about contracts. I think that's very different in the US than in Belgium, certainly for early stage companies. The keep it simple, stupid is the best advice there that I can give anyone. There are these vehicles in the US called safe agreements that are convertible loans, but are a really good instrument early on to keep things simple and have the process go fast without having to use a lawyer. But that being said, get a lawyer when you raise money, because it is incredibly important. And then do gut checks throughout the process. This is also something that I would do both with, if you're an entrepreneur as well, make sure that the idea that you have, that you're working with the right investor, that the investor is the right match for your company. It's very tempting to just accept anyone who believes in you. But there are just some ideas that don't match a certain investor or don't match a certain corporate. And that's important to keep in mind as well. That's the quick thoughts that I wanted to share. I wanted to make sure that we have enough time for Q&A. So Robin, maybe we can jump into that right now.
That's perfect, Jean. Thank you very much for your interesting story. We have two interesting stories on fundraising in Corona times in New York. Any questions till now? So we have a question from Philippe for...
yeah, I see it.
What are the biggest differences in pitching between US and Belgium, and which one do you prefer?
It's a really good question. So the bigger differences, the biggest differences are the way you tell your story. I think Belgian investors, or European investors for that matter, are very sensitive to the numbers, the data, the euros, the financial plan. And so when I do a pitch for investors in Belgium, like in some way I incorporate some numbers of this is the revenue, or this is a business plan, or this is a sales, the hockey stick sales evolution. In the US, that discussion only happens in the second, third conversation. And certainly for early stage companies, what you see is that US investors, they want to believe in the story. They want to believe in the entrepreneur. They want to believe in like the long-term potential, but they're placing bets, right? And they're not doing too much analysis. They're just like placing bets. And that means you have to focus much more in the US on the storyline, on the vision, on the big picture. Like, how is this going to be huge as a company, and how are we going to build it into something huge? And if you do that well, they're just gonna put the money on the table, to be honest. In Belgium, what you see is a much more analytical mindset. Which one do I prefer? I think in our in our stage, it's better to have that US one, just because you can convince an entrepreneur, an investor based on the story, because the numbers are still pretty limited. So I would say US probably.
Do you agree, Joris?
I would agree, but the ambition on the US side is 5 times higher than Belgium or than European investors look at. So the reason for all the bean counting on the European side is because people are very acutely aware of how much it will cost to actually conquer each and every specific market. There's an inherent set of complications when you want to grow in Europe, where in US you are accessing an enormous market of consumer, which is by definition very homogeneous. Comes with that also the increased cost of certain profiles. So developers and sales will cost you 2 times easily in as much in US as in Belgium. So the entire, take your best case scenario of your European case that you pitch to a European investor. double that, and you might be on the low end side of the US investment.
Yeah, just an anecdote there. I was in the beginning, I was raising in Belgium, and I was raising a $500,000 round. People were very critical of that, and then I started raising, or I started having pitches in the US, and the first ones, people were telling me like $500,000, that like we're not even looking at that. Are you serious? So they're really focused on bigger rounds, knowing that the costs are higher. And the way we're trying to make best use of that is pitching to US investors, but at the same time building at least a big chunk of our company in Belgium. So that kind of offsets a little bit of the dynamic that Joris mentioned and makes it interesting for us.
Yeah, compared to if you're in New York, Belgium will be a low cost country, right? So it's good to offshore your R&D.
Yeah, it's like how we look at, I don't know, Ukraine or India for tech people. That's how New York looks at Belgium.
Yeah.
Okay.
I'm reading like the valuation gap.
We have a few questions regarding corporate venturing and entrepreneurship. Maybe we would focus on that. So Joris, you have a question from Ruben, who's saying, is corporate venturing seen as a danger by VCs?
Hardly, because they are accessing the market with completely different agendas. I like VCs in the sense that they have a clear financial agenda. They do not know more about the business than you do, or rarely. They come in. I wouldn't say their strategy is spray and pray, but at least they are obliged to take a portfolio approach to the vertical that they are investing in. You are one of them. They might do other investments into adjacent companies or even competitive companies just to see what happens. And they want to be out in 3 years or 5 years with a good return. An industrial or a corporate investor has a completely different thing in mind. In the end, you might get incorporated into the bigger corporation. And so it turns out that VCs see corporates as a nice exit strategy. So what you will see is after a seed round or after a Series A round, a Series B round, you might see that the Series B round will be constructed with one financial investor and then one industry player. Yeah? So the bigger rounds that you read about is often done like that. And so the CVC will come on board and typically will try to gain a majority in that scale up the moment that it shows a real traction.
Okay, perfect. Jean, you had a question from Reinhard. You've been an entrepreneur and now you are you've been an intrapreneur and now you are an entrepreneur. What are the biggest differences between those two? And when do you know that it's time to make the switch from intra to entrepreneur?
I could do a 1-hour session about that question alone, but in as short as I can, I think that there's advantages and disadvantages. So purely practically, as an entrepreneur, you still have the stability of being part of a larger corporation, which is very nice. And at the same time, you get to work on your own initiative. Being an entrepreneur allows you to, set your own strategy and priorities and set the pace of your organization. So it's a very, very different practical thing. I always say that if I could build Esther the way I wanted it to be, with all the autonomy and freedom that I have today, but I could do it while getting a wage from a company, I would immediately say yes, right? So that's I think there's a pressure that comes from being an entrepreneur that is great and at the same time not always easy. The question is like, when do you know it's time to make the switch? I think it always has to do with your idea. And I think becoming an entrepreneur or an intrapreneur for that matter, is something you should consider when you have an idea. It's not a trade that you choose to do. It needs to come from something from the heart, or really something that you feel like you're the best person to put this in the world. And then intra or entrepreneurship is basically a means to an end, right? And if you feel that the best way to put your idea into the world is through entrepreneurship, by all means, go for it and do it. If it's impossible to do it within a company the way you want to do it, which is something that I see pretty often with entrepreneurs, I think it's ready. I think it's a moment to make this step, right? But it's a step, and you should be ready to also take the responsibility of becoming an entrepreneur. And then the last thing that I want to add is that in the end, the reward is also different, right? So as an entrepreneur, if you're lucky, you'll get like some kind of stock option or some kind of shares in the project itself, although I haven't seen that a lot. If you're an entrepreneur, if it turns out to be a great success, you have the opportunity to make some nice money for yourself.
Okay, so we have a rather technical question, and maybe that's one for Joris to take first. So go ahead, Joris.
The pros and cons of convertible loans. Yeah, I could film another session on that. So it's true, and regardless of geography, it's true that you can shoot yourself in the foot in the next round with the convertible loan of the first round. So there's yeah, a fair warning in place there. That's absolutely true. Valuation cap, I always advise against it, because indeed it will be taken as a data point of the next investor as indeed the valuation that you had in mind, even the maximum valuation possible in that time frame. So it will never go over that. I always advise against that. It's also yeah, and unwise to make prediction on that. Conversion discounts, yeah, we see that all the time. So standard market practice is that you will have, on a 3-year convertible loan, you will have a 15 to 25% discount. And that's no different between Europe and US. There is a more mature market on convertible loans in US where I mean, Jean already mentioned SAFE. I think that's a pretty standardized product that people are using in US. Here, everything is bespoke, so it's a contractual convertible loan between two parties, but it basically always comes down to more or less the same thing. If you go too aggressive as an investor on the discount, you will limit your chances of it being approved, but especially in times like these, it's a very popular instrument to circumvent some valuation discussions. So as we speak, we're actually in negotiation rounds of at least 3 fundraising rounds that are indeed at least partially going to end up as a convertible loan.
And I want to add to that, Joris. To me, it's a matter of maturity of the company as well. Like I think one big reference point in the evolution of a company is the point where you're able to make an informed valuation. And I see convertible notes as a tool that you can use pre that reference point. But once you do a valuation, then I would argue like be very careful and try to just have people come on, you know, for the valuation that you're setting for your company. Does that make sense, Joris?
Yeah, I think so. I think one of the major factors in a convertible loan is what triggers it, who triggers it, let alone the preconditions that would apply. But is it automatically converted? Is it some kind of a bullet? Is it converted by the entrepreneur? Is it converted by the investor when certain milestones have not been hit? That's super dangerous if you don't really prepare for that, and if you don't really understand what you're signing there.
Now, Jean and Joris, I have a question also. We have every year quite some startups coming out of our program that eventually also reached the scale-up phase, and some of them have around 30, 40 people nowadays. Of course, this is a difficult situation now. There are a lot of interesting ideas in the MIE, in the Master Innovation Entrepreneurship at this point of time. But what would be your advice for those people right now in terms of funding, in terms of funding strategy, in terms of general growth strategy at this point of time?
Again, I think you need to think about the sector that you're in. If you have an idea on hospitality, I would hold out for a couple of months. Other things, we talk to most Belgian VCs on a weekly basis. We don't see any slowdown in deal flow, so I would just carry on. If you do have an idea, you should max out on your financial mix. So you should have a look at subsidies. I'm not promising anything, but what we do see is that institutions are a bit more lenient in paying out intermittent milestones. I wouldn't say they would be more lenient on approving them, but that's definitely an important source. And from the government funds, there's quite a few things coming, probably even this week. And again, what you will see on my slides as well, service revenue is not a bad word. Okay, so I know everybody's dreaming about building an app and then earning money by just sitting in your seat and seeing the license revenue stream in reality, it's never ever like that. So between 20 to 30 up to 50%, especially in the early days of the revenue, can be service revenue. By doing, you will learn. You will build your network, you will build your credibility, you will refine your product. The way how you build your product will determine how quickly you can move from service revenue into product revenue. And you might start off on a service, productize what you do, and that's almost always a guarantee for a good product with an automatic market fit. Investors love that, especially these times.
Yeah, I broadly agree with that, Joris. I think if you have a great idea for a business, just do it. There is no good time or bad time to do it. If you're going to wait for the next moment where the market is going great, I mean, after that, it's going to have there's going to be a downturn anyway. So just do it. You're probably going to have to be even more resourceful than ever. And in terms of funding strategy, totally agree with Joris. We started the company with a Vlaio subsidy of 100K. We've been adding, win-win loans in Belgium, and I would say that Belgium is probably one of the most very early startup friendly environments in the world, because we have all these tools that support entrepreneurs, and the only thing you have to deal with is that the paperwork is difficult, and if you want to hire people, it's a little bit more expensive, etc., etc. But the advantages are there as well. Very practically, just build as much of a cash reserve as you can in some way. So being resourceful on services, like doing side projects, what Joris was telling, totally agree. Don't be too picky about your being, people always say you have to focus on your one thing, but in these times you have to be open to just have short-term opportunities that you can capture and build as much runway as possible. And what investors are telling me is where typically an early stage startup would try to raise for 12 to 18 months. Now you have to raise for at least 2 years. And then in terms of what's going to happen in the markets, I think that the main thing is that we don't know what is going to happen still, right? We went from, I think, March and half of April, which was the WTF phase, and everybody was like, what is happening? To everybody is protecting and everybody is on the defensive. And I think we're still in that phase where investors are protecting their current portfolio, but companies are also protecting their cash and trying to guard what they have. We're quickly going to go into that next phase where people are going to adapt and look for new opportunities. And I think that as a startup is what you should do.
Okay, maybe one final question. Jean, you have some, you have extensive experience in corporate venturing in Europe. Then you moved to New York. How did you see corporate venturing evolving over the past 5 years? And do you see any differences between Europe and the New York situation?
Sure. I think corporate venturing in the US, like it's interesting. It kind of started in the US and then came to Europe, but I think Europe did it in a much more professional and thoughtful way. And I think the US, up until a few years ago, their corporate venturing logic was more of a branding logic of an R&D play. They were buying companies at these crazy valuations just because they had the capex to do that, and they were like, sure, why not? We had a coffee brand with 30 stores being bought for almost $500 million. It was just mind-boggling. What I see now is that these corporate venture players are starting to, here in the US, are starting to act more like VC funds. They're starting to really look at the story, look at the added value, look at the financials a lot more in general. The problem with corporate VCs that I see in the short term is that it is like investing for these corporates. It's not core, right? It's something that they do, that they see as an opportunity, but it's not their core activity. While for a VC, they exist to invest their money and to deploy their capital. So what I think we'll see moving forward is that the smart corporate VCs are the ones that are going to start moving in the next couple of months and are going to start making investments. The ones you'll be able to see which ones were just marketing plays, where a lot of those corporate VC guys and accelerators and incubators and all kinds of vehicles are just gonna disappear or just stop investing. That's my biggest take on it, if that makes sense.
Okay, thank you, Jean. Joris, would you agree? Would you have similar observations if you look at corporate venturing, of course, from a startup CFO perspective?
The skill set of people working in a CVC is different than a VC. So you might heard about Shark Tanks and all those kind of things. It's true. On the VC side, these guys are tough. They can be pretty alpha. So it's not a pleasurable experience even going and landing an investment with these guys very often. And even then, the pressure is always on. That greed and that agenda. You need to have a special brand of people who are willing to step into that. The corporate VCs are typically people. You have two options. Either they are coming from within that industry and have loads of ideas, a unique background, and they are relatively fun to work with because they have that bigger goal of adding that value to the industry or to the corporate in mind. The other option is that, and sometimes you do see that, people from a VC background actually move into a corporate VC are going to lead some kind of corporate fund and bring in that skill set that they learned in their VC days. And that's of course a dangerous combination because they have nearly unlimited funds. If you're working, I would say, for a SAP, for a Bayer, for a Boehringer Ingelheim, if you combine those kind of deep pockets with the skill set that they learned on negotiation, on modeling, on financials from your VC days, that's a pretty tough nut to crack. So you need to, as Jean says, you need to build a long list and also feel if you vibe, if you synchronize with that person in that CVC fund, because you might not necessarily have the right connection with that person, although you always aimed for that type of industry or that type of company. Yeah.
The thing that we saw this morning in Tel Aviv is that corporate venturing is moving more from should we acquire or not, or should we invest with the VC mindset or not, to more a situation where they take startups very early in-house and where they more or less are moving towards co-creation or co-creation relationship with startups. Is that something that you also observe in New York?
Yeah, I want to jump into that because in my opinion, that's not corporate VC. Like I see it happening that very early stage companies, I would call it, fall into that trap because they're getting bought very early on and then they get to do a pilot within the company, basically. And then my advice would always be go to them, tell them like, well, I want to do a pilot with you and you can like co-create with me as much as you want and you can pay me and we will both invest, etc. But in order to make this valuable for your company and in order to get to a place where we can talk about investment or acquisition or whatever, we want to do pilots for other companies as well. And any company, any corporate that is telling you like you're basically an idea or you haven't done any revenue or any sort of traction, and they tell you we want to acquire you and then you can work within our team, they're not acquiring a company. They're acquiring a technology, they're acquiring a person, they're acquiring an idea, some IP maybe, but they're not acquiring a company. And I would always warn for that. And if they want to buy your company that early, you can probably turn it into a conversation of become my first client, become my first customer. And that's, I think, what you should do at that point.
Okay, thank you very much, Jean and Joris, for sharing all your insights and for your interesting stories. So thank you very much, guys, for paying it forward. This is very, very useful. Of course, we always have a last minute question, and this time this question is from Alexis. I heard from the CEO of a scale-up in Austin, raised over 20 million, that several VC investments use individual VCs for the execution and overview of the project. Can you elaborate on that, and maybe quite short because we try to finish in a few minutes, if that's possible?
Yeah, we see that in the sense that a VC is nothing else than a special purpose vehicle that pulls money from parties. These parties are called limited partners. What that means is that this can be a high net worth individual. It can be Mark Koeken and Urbain van Deurzen, but it can also be a large bank, or it could indeed be a VC arm of a large corporate. So companies who are honestly coming to the realization that they do not have that skill set that I talked about before in-house might want to outsource some of that work to a VC. So what may seem like a large amount of money for even an investment or a partner in a VC fund, let's say 15 million euros, is pocket money compared to these very large corporates. So they seed, let's say, 2 or 3 VCs where they know they're gonna look and prospect in the space where this corporate company is also active in, and they just interested with the money and they just see what the VC does. And when it gets really, really interesting, or when the time for an exit is there, they're at the first row to actually buy that startup, hopefully at a lower price than what a truly competitive external M&A process would produce.
So, I can say it in 10 seconds, Robin. The fund that invested in our company has as LPs a bunch of food and retail companies. And so what they do is connect us with those LPs and with the people within that limited partners companies that want to work with us. And it's a great source of pilot leads for us.
Okay,
so it happens.
Thank you very much, both of you, for paying it forward. Thank you very much for your time. and we will close the session here. So thank you very much, guys.
Thank you very
You're
much.
welcome.
See you
Have a
later.
great day.
Bye-bye.
Bye.